Today, folks, we need to talk about the state of the global stock market, what it means in the macro as we review the best possible ETFs to buy in 2025. Doesn't matter where you're at in your investing career, if you're heading toward retirement in the next year or you've got 30 years ahead of you, these ETFs will be easy to implement into your strategy. So if you're on a path to financial independence, if you damn well one day want to retire early, join me by simply hitting that subscribe button, because before we talk about these ETFs, I really want to break something down that general media is just not discussing today. The US dollar is hitting roughly a 25-year high, unlike anything it's seen with the exception of the dot-com bubble era. And I want to talk about what's causing this, because we've seen a mass exodus of global currencies. The Canadian dollar is down about 6 to 7% in the last year. The Japanese yen saw some massive fluctuations with a 10% drop just within a few months leading into the end of 2024. You've got the euro here, which also saw some mad fluctuations with a 7% decline. The Indian rupee, it doesn't matter what country you go to, you have to ask yourself, why is the US remaining so dominant? Why are other currencies collapsing? And it has everything to do with interest rates and the teetering of a recession that so many countries are facing, whether it's Canada, Europe. Every country right now has been dealing with the impacts of COVID, inflation, and all those tailwinds, whereas the US has been a little bit more stable, able to leave their interest rates higher than the rest of the world. And what ends up happening when other economies are basically cutting their interest rates really aggressively and the US isn't, people will start looking at the cash they have and they don't want to put it in high risk investments. They want to put it somewhere safe. So what they look at doing is, where in the world can I put my cash today where it's going to earn the highest yield and give me the greatest return? And with collapsing global currencies, people look at the US dollar as a safe haven, because not only are they getting higher interest rates from money market funds, but they're also getting the tailwind of their currency devaluing, meaning the US dollar they hold in money market funds is actually giving a much higher return when they convert it back. But I'm going to predict right now that in the coming years, when the US actually starts cutting their interest rates more to be in line with pretty much what's going on globally, we're going to start seeing a mass exodus of basically the US dollar. Because if we start seeing an inch of recovery in global currencies, it's going to get people a little skittish that they're going to start losing those higher rates of return that they're getting out of US money market funds. And we could start seeing a massive shift, as basically right now there's potential that we're sitting in quite a valued bubble. If you look at companies like Apple, a lot of people have been flooding foreign capital into these high-flying tech companies, but Apple, the largest company in the US, trading at a 40 times multiple. A PE represents how many years it will take for you to get a full rate of return if basically revenues and earnings do not change. So for Apple to even be fairly valued, it needs to double up everything that it's done so far today, or you're going to be sitting here for a very long time. Stocks short-term are voting machines. More people are voting for these companies, driving up these values. Meanwhile, reality might set in the coming years that could cause also an exodus from these high-flying stocks. So we could see some real volatility as this market continues to propel in the future. So just keep that in mind. I don't know what's coming, but there's obvious concerns of bloated valuations going on in the United States from currency to stocks. So keep that in mind. So we're going to start with the safest investments you can make. If you're basically 20 years old, you've got a 40-year time horizon ahead of you, you're not looking to retire early, you just want to focus on your job, live your life, start a family, but make sure you have funds that are going to get you there. And we're talking about the Vanguard Total World Stock Market Index Fund. Now, we're going to start with the safest, best investments you can buy to the more riskier and things that I personally buy, because this ETF probably becomes the most recommended because it has a crazy low expense ratio and it is a total world stock market ETF. And essentially, it just means that what's going to happen is these ETFs weight companies based on their market cap performance. So Apple sits at the top of these ETFs because it has the largest market cap, which dictates how big of a percentage it's going to be in these funds. And this ETF is doing this with the entire world. So there's no emotion involved. If Apple starts to underperform other companies, it'll start to de-weight its percentage weighting in these ETFs. So there's no emotion involved. There's no, is this company cheaper valued? Is this one too expensive? If they're performing, they get a higher weighting in the ETF, which is why we can see Apple, Nvidia, Microsoft, Amazon, Meta, Google make up the top holdings, but globally, we're seeing some mass rallying going on in chip stocks like Taiwan Semiconductors that has now made its way into the top 10 list. And if we go down, it's very likely you're going to start seeing companies that are globally based, but obviously because the United States dominates the world right now, they're going to make up the vast majority of the top weighted holdings. But I'm sure as we go down, you'll start seeing things like Tencent, Alibaba, some of those companies as well, right? So this is like an end all be all investment strategy for most people that want to passively, manage their portfolio. Because if US stocks start to underperform, it won't matter. It's likely other countries will start ticking up performance in comparable. This also for Canadians, if you want to look at a global market ETF, you could look at XEQT, which has pretty great performance. It's a more recent ETF that only came about in 2019, but very similarly, if we take a look at the holdings and the dividend income, this is probably a little bit more pronounced for Canadians because the yield is quite a bit higher at 3.23%, whereas I believe the Vanguard ETF sits closer to about 2%. Don't quote me on that, I'd have to take a look. But yeah, so basically you can take a look at this one for getting income and global diversification with a fairly low expense ratio. It's a lot higher than VT, for example. This one has about a 0.2% management fee, which is like my breaking barrier. You don't want to be buying even mutual funds or ETFs that have anything higher than about a 0.5% management fee, because that really eats into your total returns and your compound return over a 30 or 40 year period. So about 0.2% is my breaking point. And this has like the US total stock market. If we take a look at the diversification, it's mostly US. It's got Canada in here. You got Japan. It's an awesome way to globally diversify as a Canadian, get a higher yield, so you're collecting income on top of that. And you can take a look at the holdings in here because they're very intriguingly diversified to get that yield. So just something to point out. I'm not going to do too many deep dives. I just want to point out the best ETFs. So let's look at something a little more concentrated, a little more risky, and that is VOO. This makes up 50% of my portfolio right now, and it is highly concentrated today, primarily in the top weighted tech companies, which I'm recognizing are sitting in somewhat of a bloated territory situation, because with the exception of, say, NVIDIA, that has exceptional growth right now, Amazon is a pretty premium-based company that has a lot of headwinds if Trump introduces tariffs, with over 60% of the income Amazon is making is coming from China, so there could be some real concerns there. I still think Meta and Google are great companies, but Tesla, I don't want to say it's a vaporware company, but everything Elon's promised has not come into fruition yet. It is one of the top 10 largest companies in the world, but makes not nearly close enough to justify the values today. And a lot could be said about many of these companies right now. They're very expensive for the returns that we're getting, but I am just patiently holding this, knowing that the US isn't going to cut interest rates very aggressively. It's likely, presuming there's no black swan event, this ETF will still have relatively strong performance. And if you compare it to VT, you can see that the top weighting is Apple at 7%, where it is in VT, we can see the top weighting here. And I just want to point out how diversified this is actually, let me zoom out a little bit. We already, we're way too deep down into this, but if we go back to Apple, we can see it's 3.81%. So you're getting less performance. Concentration equals performance, but it also equals volatility, because over the last 5 years, VT's offered a 44% return, whereas VOO has offered about an 80% return, doubling up that performance. But you have to understand the concentrated risk that you're kind of putting yourself at, not quite sure where the US market's going to be in the future. And if we take a look, information and technology in this ETF make up about 31% of the holdings, and the top 10 holdings are highly concentrated between a lot of tech companies. So just do keep that in mind if you are looking at VOO. If you're Canadian, you can look at this in every single country from China to Europe. You can find Vanguard will have a market cap weighted, a passively weighted ETF in your country. So look at VCE. This is the Vanguard Canadian Index, very similar to VOO. This is concentrating the top weighted Canadian stocks. It's got a very low management fee at 0.06%. And I should point out all Vanguard ETFs have very low expense ratios. VOO is at 0.03%. This one has a yield of 2.69%. And I should point out, I think VOO has a closer to a 1.2, 1.3% yield. The Canadian markets are more dividend focused. They're not as tech weighted. They're more, older infrastructure oriented companies and financials. But at 2.69%, let's just take a look at the weightings in here. It's a juicy dividend to be collecting right now. However, we can take a look at the holdings. If we scroll down, hidden in here somewhere, if I did not pass them. Did I pass them? Let me scroll back up here. Pay close attention, because they're always hidden in here here somewhere. If we take a look, we can see Royal Bank makes up 8.7%, actually being more concentrated than the US markets. And that's because Canada, again, has much fewer companies, and our largest company in Canada is Royal Bank, and it takes up a huge market cap weighting. Surprisingly, Shopify has now become the second largest market cap weighted company, which makes up 6% of this ETF. Toronto Dominion at 4%. You can see Enbridge in here, Brookfield, Canadian Pacific, Kansas City. This is a railway company along with imagine Canadian National Railways in here. You got Canadian Natural Resources, so a lot of energy infrastructure kind of stocks, which tend to come with higher yields and typically a bit more stability. Canada is made up of monopolies. There are very few companies in every sector that have control. So I like these ETFs personally. I don't own VCE, but we'll take a look at the ones that I do own in a moment. Now, I would be a little bit more concerned, but if you have a long time horizon, you want more growth, a lot of people will look at the Qs. These are very famous ETFs, the QQQ ETF, which basically represents the NASDAQ 100 kind of technology companies. And if we take a look at this fund, the dividend yield is basically non-existent here, but it has an expense ratio of 0.2%, which falls in line with a lot of my check marks that have to be ticked in order to buy an ETF like this. But it is doubling down on the concentration. Basically, it's just heavily weighted in tech like Apple, Nvidia, Microsoft, Amazon, Broadcom, Tesla, Meta, Google, Costco's in here. These are all very, very, very expensive companies, and historically are more expensive than they have been in the past, with the exception of the .com era. And you really need to be cautious and have a long-term time horizon if you're buying these, because they do come with a lot more volatility risk. And in the current market environment, I would approach these with a little bit more caution. Not as financial advice, it's just my own personal opinions and how I feel about it. So a lot of people are shifting and looking at more value-oriented ETFs. I should point out as well, you can get equal market ETFs where they basically equal weight all the companies rather than top weighting, but I don't think that's a healthy approach to investing, because you want the upper weighted stocks, the performers, to make up the vast majority of your portfolio. Total returns do matter. I don't think dividends should be the end all be all, but I am a dividend advocate, and I buy these dividend ETFs starting with SCHD. This is a US dividend ETF, and it's a really world-renowned one. A lot of people have high hope. It has been underperforming the US markets on the back of the massive tech rally, but it offers very stable growth and is very diversified for those looking for income that might be closer to retirement. As mentioned, I'm somebody that maybe doesn't have the most stable job as everyone out there. I always have concerns that if I lose my job, I do want to have some backup income, and that is why I focus on dividend income earlier than most people probably should, just because I don't trust my job stability long term, and I also want to retire a bit earlier, and I want to know I have access to these dividends if I ever need them. And SCHD comes in with a very low expense ratio of 0.06%. The current yield, I think, sits around 3.7%, give or take, hovers between 3.5 and 4%. If we take a look at the portfolio holdings, again, these are very stable sectors. They're called defensive plays because typically in recessionary environments, these stocks do exceptionally well because they don't go anywhere. They're highly needed in society, unlike tech companies that can go ebb and flow depending on what the next technology is. Pfizer, AbbVie, these companies in the healthcare are probably not going anywhere anytime soon. You got BlackRock and Coca-Cola. You got Verizon, communication companies in here. I know Pepsi's in here. Home Depot's in here. Hershey's in here, a lot of food companies. If we take a look at the sector allocation, financials make up 18%, healthcare 15%, consumer staples at 14%. You'll notice technology is one of the smallest weightings in here. So you're not seeing the same kind of growth performance as you would in tech ETFs or S&P 500 like ETFs, but you can still buy this knowing that your dividend income is likely to dramatically increase over time. These are great compounders. 10 years ago, this thing was offering about 9 cents a quarter. Today, you're at about 26 cents. So a decade later, well, tripling the dividend. So you're getting great dividend increases that are fighting inflation, and you get very stable returns. You're just not going to get explosive returns because, again, these are more stabilized, industries that have been around and are much more solidified. We could also talk about some other ETFs that people like in the dividend realm of things. There's things like VYM, very similar to SCHD, but focuses on different industries. So you got Broadcom, JP Morgan, ExxonMobil, Home Depot, Procter & Gamble, kind of upper weighting more of the S&P 500 large cap dividend payers. We could also talk about DGRO. There are some growth dividend ETFs that pay lower yields, but focus on stocks that, pay much more faster growth in their dividends. So the management fees also, these are all exceptionally low dividend fees. But you can see Broadcom and Apple are in here, Microsoft's in here. So you're going to be paying a much higher premium For an ETF like this, the stocks might be a bit more expensive, but it's likely you're going to see better dividend growth, because right now the yield on this one is probably fairly low, I would imagine. If we can find it in here, just briefly, let's take a look here. Where is the dividend yield? Yeah, it's sitting at about 2.12%, right? So if you have a longer time horizon, you're looking for better dividend growth rather than looking to tap into the dividends today, this could be a good option as well. Now, on the Canadian side of the border, VDY till I mother friggin' die. I love this ETF because it typically matches the performance of the broader Canadian ETFs like VCE, but it primarily focuses on the dividend kings here in Canada, which, let's be real, most of the large cap companies are dividend kings, with the exception you're not getting Shopify. You're not getting the growth stocks, again, which is why I focus on the S&P and some of those ETFs for growth companies. But in Canada, I just want dividend income, and I get it from this ETF, which currently pays, cost about 0.22%. The 12-month yield is at 4.25%. Checks all my boxes. Great starting yield, low expense ratio. It pays a monthly dividend, one of the only monthly paying dividend ETFs in Canada, which is great. And it really upperweights Royal Bank. It concentrates based off market cap, just like VOO or VCE does. So keep that in mind. I wouldn't make this a massive holding in my portfolio because it's very concentrated in a few companies, being Royal Bank, Toronto Dominion, Enbridge. So you have to keep that in mind when you're looking at some of these more concentrated dividend ETFs. You do not want to make them like 50% of your portfolio, because if Royal Bank or Toronto Dominion, the financials get hit super hard, you could experience a massive fluctuation. As we see, this ETF is much, much more volatile than, say, something like SCHD is, because of the mass concentration that it holds. But again, we're talking about great dividend compounding growth from about 7 cents to 12 cents monthly to where we sit today, where we're getting about, upwards of 19 cents, 20 cents. So, a great doubling of the dividend over the last decade, and we can see the dividend concentration and the payments are getting much more equal over time. So I love this ETF. It's definitely one of my favorites. Now, we have a few honorable recommendations if you're Canadian. There's XDIV. These are other ones that the reason I choose VDY over all of them is it has the best performance. These other ones, though, if you're looking for income and performance doesn't matter necessarily as much, these are great ETF recommendations as well. This one, so XDIV, pays a very healthy yield. If I do recall, we're talking about 4.37%, has a very low expense ratio, lower than VDY at 0.1%. And we're talking about companies like Enbridge, Royal Bank, much more concentrated in the top 10 holdings, because we can see Enbridge, Royal Bank, Sun Life Financial, Toronto Dominion, Manulife, these all make up about 9% weightings. You got Fortis in here, Power Corporation, great companies overall. But the Canadian economy is primarily financials, energies, and utilities, maybe a bit of communications as well. But you'll see this is very similar across all of these ETFs. They primarily hold the same companies, just in different weightings. XEI is another really great one for diversification if that's what you're after. XEI currently pays about a yield of, what are we talking about here, 5.49%, probably being the highest of all the dividend ETFs we're going to look at, with a 0.2% expense ratio and much more diversified. The top weighting is Enbridge at 5%, Canadian Natural Resources, Toronto Dominion, all the same companies you're going to see, even Bell's in here, which has been under pressure as of recently. So you can see energy, financials make up pretty much equal weightings, and then you have utilities and telecommunications a little bit higher weighted than some of those other ETFs. So if you're looking for income, you can pick what one of these is going to be best for you. But to finish up, let's just take a look at a couple quick more. And again, these are honorable mentions to me because some people might want to pick individual sectors themselves, and you might do this for whatever particular reason because you think you could see some outperformance. Like utilities recently have gone on an absolute tear as big tech companies are partnering with utilities to get involved in nuclear energy. There is a massive explosion going on in the energy business right now because of the demand for cloud computing and data centers and all that kind of stuff. So you could look at these to get more stability because some sectors, again, are highly stable. You could say the same about healthcare sectors. A lot of people are looking at real estate sectors right now as interest rate cuts come into play. And again, you're going to see wildly different performance between all these ETFs. But they're really fun to look at. Like if you're in Canada and you like the Canadian banks and you want that sector exposure, you could buy something like HBNK. This is just an equal weight bank ETF, and it only holds the 5 or 6 banks Canada has to offer, and it typically outperforms the broader Canadian markets because the Canadian banks tend to do better. So you can take a look at these if you're more intrigued by a healthcare sector, and you can just Google them and find them. I'm not going to break them down individually because they do come with a bit more risk. And we didn't really talk about the small cap sector of the market either. If you're intrigued by small caps, you could look at the Russell 2000 ETFs. I'm not the biggest fan of small caps. I hand select those personally, and I'd rather focus on broad-based ETFs rather than diversified diversifying into small caps. But if you buy a total market ETF, you are going to get small caps in there as well, which is probably why it's more prudent to kind of get that total weighted market performance over a long period of time in case we see these massive fluctuations that I'm expecting between currencies, tech valuations. We are sitting in a peculiar time to be an investor in this market, so you need to remain diligent. And though this does not represent financial advice, I'm hoping from what I'm showing you here, you can implement it into whatever your time horizon is, your own personal financial experiences, because again, it's personal finance. I can't tell you what to do, but I can show you what I'm doing in hopes that you learn something today. So let me know what you think in that comment section below.